Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. As we close out the year, a year where AI displaced tariffs as the word you cannot escape, we ran across the always thought-provoking Rashir Sharma, chair of Rockefeller International, who laid out a test to identify bubbles. It's his four O's: overvaluation, over-ownership, over-investment, and over-leverage. Against these criteria, AI is a bubble, Mr. Sharma opines, and it has reached an advanced stage. He is quick to add, however, that the one constant trigger for a crash is rising interest rates and tightening financial conditions. And at least for today, and probably into 2026, those factors are not present. You can find his piece on the topic in the Financial Times. This week, our three things are: 1. Oil glut. The price of the commodity has plunged, and it's likely to stay that way in 2026. 2. Credit cycle. Phases are irregular, and the conditions for pushing into recession are relatively dormant. And 3. 2026 themes. We tally up things worth watching. All right, let's dig a bit deeper. Oil glut. Commodities trader Trafigura reported earnings this week, and the headline that caught our eye is that management characterized the oil market as being in a state of, quote, glut or super glut, unquote. In some respects, this is not news given the 28% downdraft in the price of oil from its peak in January. Brent crude, having pierced $59 a barrel, is now 24% below its 20-year average. The reason, as is usually the case, is driven by changing supply and demand. In this case, the commodity price is getting hit on both sides, a burst of supply amidst weakening global demand. On the supply front, OPEC Plus production increases earlier this year are creating what is expected to be a record supply-demand imbalance in 2026. Now, indeed, observed inventories rose to four-year highs in October, according to the International Energy Agency. Meanwhile, growth in global demand in 2025 was 800,000 barrels a day, down from the pre-pandemic average of just under 2 million. The growth in alternative energy sources and global economic slowdown to a low 3% forecast for 2025 and 2.9% expected in 2026 are instrumental in the move. Now, there is hope for change. The outlook for global growth has picked up a touch on improved expectations from the U.S., and the relentless surge in supply has come to an abrupt halt, according to the IEA, in part due to sanctions imposed on Russia and Venezuela. From an economic standpoint, falling oil prices can be viewed as another form of stimulus, with gasoline, for example, in the U.S. falling 11% from its April high. A move of that magnitude would essentially serve as the equivalent of a tax cut to consumers, and lower oil prices could be materially beneficial to heavy oil users, such as airlines, trucking and logistics, chemicals, agriculture, and manufacturing concerns. Predicting oil prices is never easy, but at least for now, for 2026, the price of oil should be positive for credit, at least apart from energy producers. All right, on to our second thing: credit cycle. So we did a recent presentation on the credit cycle, something that is neatly laid out by a number of sources, typically with four phases: expansion, recession, repair, and recovery. Knowing where you are in the credit cycle is important, Investopedia tells us, because it can have far-reaching effects on borrowing, investment, and financial stability. Makes sense. If only it was as mechanical and elegant as it's laid out. It's not. Recently, certain market developments point to late cycle behavior. We got that, or that interpretation, recently from Apollo, for example, which referred to the credit cockroaches as, quote, late cycle accidents, unquote. In that late cycle or expansion phase, financial conditions are easy, asset valuations are rising, corporate profits are abundant, and volatility is low. The next stop in the cycle is recession. Okay, here's where it gets interesting. The last time we had a recession, taking out the 2 months of COVID in 2020, was nearly 17 years ago. And over that time frame, the U.S. has grown at an average rate of 2.2% above potential. What kind of cycle is this? Well, it's an irregular and inelegant one. What's important is looking for turns in the cycle, particularly negative ones. And that happens when there is a shock to asset valuations, a repricing of risk, Think central bank over tightening, or a correction to an asset bubble, as was the case in 2008 in the mortgage market or 2001 among internet and telco names. Another way to think about this is that there can be a bunch of mini recessions along the way where individual sectors get hit. Think about energy in 2014 or retailers in 2018. So, are we looking at a turn in the credit cycle, either broadly or in a sector? Well, the answer from our perspective is no. The high profile deterioration of a handful of one off credit accidents does not point to widespread misguided underwriting of credit. The growth in private credit is simply a redistribution of leveraged lending from banks and market funded commercial finance companies to a myriad of institutional investors around the world, where the net effect is greater dispersion of risk and more prudent match funding of loans. Overall growth in leverage finance matches nominal growth in the economy, so that's okay. At the sector level, is there a sector worthy of correction? Well, if you believe the aforementioned Mr. Sharma, AI might be that story. But the trigger to correction, tightening financial conditions, just doesn't feel like it's a near term risk. 17 years of expansion has proven the U.S. to be a well diversified, resilient economy. We don't see a turn in the credit cycle as a near and present danger. All right, on to our third thing, 2026 themes. So as 2025 draws to a close with stocks closing at or near record highs in the US, Europe, and Japan, and credit spreads at or near 20-year tights, you could easily come to the conclusion that all or just about all is well. But then we wouldn't be bond people, or at least diligent bond people. Now would we? So what are the themes to watch in 2026? Here's what's top of mind to us. 1. The path of inflation. Is it sticky high? Could it reaccelerate higher, or is it essentially back to target once you strip out one time tariff related increases? A lot hinges on the path of inflation, the degree to which the Fed eases further, the resultant risk premium in the Treasury market, and the support for equity valuations and all that falls from that, most notably consumer spending. It will also be interesting to see how powerful disinflationary forces are, namely AI and automation, deregulation, and Chinese overmanufacturing capacity. 2. The evolution of artificial intelligence. From a financial market standpoint, this was the year of AI going mainstream. It drove much of U.S. GDP growth. Its chips became the bargaining chip in a resetting global order. Its potential drove the equity market to new highs, and its capital needs accounted for an estimated 25% of the U.S. public investment grade bond issuance in 2025. Its emergence has moved productivity back to top of mind considerations economically. Uncertainty around just how productive AI related capex is will continue to lean on this story as that gets better defined in 2026. Improving visibility will better define macroeconomic outcomes and microeconomic winners and losers. 3. The broadening out of economic growth. Falling on the economic dominance of AI, the breadth of economic growth has our attention as it speaks to economic and credit resilience. As it stands today, according to FactSet consensus, 7 of the S&P 500's 11 sectors are expected to post double-digit earnings gains in 2026, led by infotech at plus 27%, materials plus 22, industrials plus 15, communication services plus 12, financials plus 10, and utilities plus 10. No sector is forecast to have a down year-over-year result. 4. The strength of consumer spending. Corporate profits are strong and margins are high. That spells good news for consumer spending as unemployment figures to remain low and wage gains don't figure to lose out to inflation. But sentiment is poor, which means that confidence is fragile. Moreover, wealth effect among the wealthiest has been so important and powerful, a correction, overdue, in stocks could present a meaningful headwind to spending in 2026. 5. The persistence of geopolitical friction. We often remind investors that geopolitical headlines do not typically impact financial markets all that much. They do when those developments impact supply and demand of something, usually oil, or, in the case of last spring, trade flows and costs. While uncertainty around trade policy has diminished over the course of 2025, it hasn't gone away, and tariffs remain prominent in the administration's foreign policy toolkit, ready to be deployed at a moment's notice. And while the Supreme Court could make a significant part of tariffs illegal, we believe the administration would seek out other means to achieve similar outcomes. And 6, the rise of event risk. Investors have not had to worry much about event risk for some time now, as the previous administration's anti-M&A posture and heightened uncertainty kept bondholder value-destroying transactions to a minimum among larger firms. That's all changed, and event risk is back. How much will determine if a meaningful risk premium embeds into the spreads of non-financials. So there you have it. 3 things in credit. 1, oil glut. Lower energy costs for the most part is a credit positive. 2, credit cycle. Risk of tripping into recession we think is relatively low. And 3, 2026 themes. Growth is healthy, but growth engines are narrow. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. Thanks for checking in with us throughout the course of the year. Have a healthy and happy holiday season, and we'll see you all again in the new year. On behalf of all of my colleagues here at KBRA, all the best.